Hello, everyone, and welcome to Strategic Management of Multinational Corporations, Lecture Note 2, Goals, Values, Performance, and Business Models, based on the academic courseware by Professor Shihmin Lo. What is the fundamental purpose of an enterprise? While organizations pursue diverse social, technological, and institutional missions, strategic management recognizes one universal underlying objective: the imperative to create economic value. Over the next 10 to 12 minutes, we will systematically examine the complete value creation chain. We will deconstruct the VPC framework, explore economic value added and DuPont performance diagnosis, learn how real options help managers navigate uncertainty, dissect the balanced scorecard, and see how business model innovation and creating shared value reshape competitive advantages. Let's begin by exploring the nature of value creation. Value creation occurs through two primary mechanisms: production, transforming lower value inputs into higher value outputs, and commerce, reallocating goods across time and space through market trade. To analyze value creation and distribution, strategists use the VPC framework. V represents maximum willingness to pay, P is the market transaction price, and C is unit production cost. Total economic value created equals V minus C. Price determines how this value is shared. Consumer surplus equals V minus P, representing the net benefit captured by the customer, while firm economic profit equals P minus C. Firms achieve superior profitability through two strategic paths: doing better by lowering costs C through operational efficiency, or doing different by elevating willingness to pay V through unique differentiation. To see the VPC framework in action, consider a classic Taiwanese breakfast shop offering egg crepes. A standard egg crepe costs 12 new Taiwan dollars to produce, sells for $30, and customer willingness to pay is $50. Here, total economic value created is $38, split into $20 of consumer surplus and $18 of firm profit. Now, the shop owner innovates by introducing a gourmet cheese egg crepe. Cost increases to $16 and price rises to $40, but customer willingness to pay jumps to $65. Total economic value created expands from $38 to $49. Both consumer surplus rises to $25 and firm profit increases to $24. This micro case illustrates how value-enhancing innovation creates a win-win outcome for both customers and the firm. How do we diagnose whether a firm is truly creating economic value? Traditional accounting profit ignores the opportunity cost of equity capital, making capital-intensive firms look profitable when they are actually destroying shareholder value. Economic value added, or EVA, solves this by deducting the full cost of capital employed. EVA equals net operating profit after tax minus capital employed multiplied by WACC. Global spirits company Diageo learned this lesson dramatically after adopting EVA. Diageo discovered that aged Scotch whiskies, despite high accounting margins, tied up enormous capital in aging cellars for over 12 years. After accounting for WACC, aged whiskey produced lower economic profit than unaged vodka. Diageo promptly shifted marketing focus toward high-turnover spirits and divested low-EVA food divisions. To pinpoint the operational drivers of performance, managers use the DuPont identity, decomposing return on equity into three distinct ratios: return on sales, asset turnover, and financial leverage. Return on sales reflects pricing power and differentiation, how effectively the firm translates revenue into profit. Asset turnover measures capital efficiency, how productively the firm utilizes its asset base to generate sales. Financial leverage reflects capital structure choices. By breaking down ROAS and ROE into these components, executive leadership can diagnose whether poor returns stem from weak margins, sluggish inventory turnaround, or inefficient capital deployment, allowing targeted strategic interventions. In financial valuation, Enterprise value equals the net present value of future free cash flows discounted at WACC. However, static discounted cash flow models assume rigid, one-time investment commitments, undervaluing strategic flexibility in volatile markets. Real options theory applies financial option principles to physical assets, granting managers the right, but not the obligation, to expand, defer, or abandon projects based on new information. Crucially, higher market uncertainty increases real option value. Consider Shell's hydrogen energy strategy. Shell made modest joint R&D investments in hydrogen. While negative under static NPV, these investments bought valuable growth options. If climate regulations accelerate, Shell holds the option to rapidly scale commercial deployment. When establishing organizational goals, executives often fall into target-setting traps. Economist John Kay articulated the principle of obliquity. High-level goals like profit maximization are best achieved indirectly. Companies intensely focused on engineering excellence or customer delight often generate higher profits than those directly chasing stock price. A sober historical warning is Boeing's corporate governance shift in the late 1990s. Boeing historically prioritized engineering mastery, delivering world-leading commercial jets and strong profits. When new management shifted to aggressively driving quarterly stock performance and squeezing engineering budgets, corporate culture eroded, contributing to the catastrophic 737 MAX grounding crisis. To operationalize strategy without falling into short-term financial traps, Kaplan and Norton created the Balanced Scorecard, or BSC. The BSC balances financial outcomes with non-financial drivers across four perspectives. Financial: how we appear to shareholders. Customer: how customers perceive our value proposition. Internal business processes: what operational workflows we must excel at. And learning and growth: how we empower employee skills, technology, and culture. These four perspectives are linked through strategy maps establishing clear cause and effect hypotheses. Investing in employee training improves internal process quality, which enhances customer satisfaction, ultimately driving long-term financial returns. Moving beyond individual products, modern competition centers on business models. A business model describes how an organization creates, delivers, captures, and sustains value. Alexander Osterwalder's business model canvas maps this architecture across 9 building blocks: key partners, key activities, key resources, value proposition, customer relationships, channels, customer segments, cost structure, and revenue streams. Strategic innovation occurs when a company alters these building blocks to change the rules of competition, such as Nespresso introducing portioned coffee subscriptions or Airbnb pioneering platform ecosystems. Re-architecting the business model creates a temporary market disequilibrium that rivals struggle to copy. Finally, Michael Porter and Mark Kramer introduced Creating Shared Value, or CSV, redefining the relationship between corporate profit and social progress. Unlike traditional CSR, which views societal contributions as a cost center, CSV creates economic value in a way that also produces value for society by addressing its needs. A prime example is Unilever's Sustainable Living Plan. Unilever embedded plastic reduction and sustainable sourcing directly into product business models. Unilever's sustainable living brands grew 69% faster than the rest of its portfolio. To summarize today's lecture, strategy is about creating and capturing value, measuring economic profit through EVA, balancing operational drivers via strategy maps, and innovating business models to generate shared value. Thank you for watching SMMC LN2 with Professor Shihmin Lo. Stay strategic, and I will see you in the next lecture.